Hello guys, glad to have you on board again today. Thank you for the nice reviews you've been giving on yesterday's first video here in YouTube. So we'll keep on doing that way as long as necessary until further notice. At least if somehow we can get back to trading view, I'll eventually consider doing it. But as you have guessed also, this is much more convenient either to me and to you to be in there, as we don't have the 10-minute limitations. Allows me to get into much more details, so better educational content. And once again, that's the goal in here. It's not just me talking to you for hours, it's just me trying to get the best out of what I've been learning throughout those trading years, and to help you transmitting this to you guys while most of you beginning to trade. Anyway, let's get it started. Simply applying. Once again, the goal in here is to show you that there is no magic. It's just repeating the same thing each and every day throughout the market. It's quite an annoying thing, actually. It really is just like that. It's creating a routine that you follow through each and every day. So let's just do it once again and do as I do each and every day trading. First, having a look at the economic calendar, see what is about to be released today, what could impact the market somehow. In terms of economic news or potential forecasting that could be made out of those. So today is not a big day, not a really interesting day. All we have is low importance, and most of those releases have already been done. So from what we can see, we've got the European GDP release this morning is filling the consensus, but it's not a it's not a good number. We're actually 0.4% out of the first quarter, which is generally the best quarter in a year, which means 0.4 for the best quarter doesn't necessarily suggest the GDP is going to be 2.5% this year, as suggested, because we're basically calculating out of the first quarter and adding the 3 previous quarters of the previous years, which were really expanding, and I don't think we're going to get to this. So first quarter, not the best case scenario, which means probably having a GDP contraction to come forward. And once again, contracting GDP means that the equities return will be narrowing as well, meaning less profits. Still profitable. We're not nearly close to getting into recession actual numbers, but economical contraction, when you are in 8 years of economic growth, generally means that we're heading toward recession. And at that point, the market stops making new highs. They're starting to range before eventually getting to reverse afterwards. Okay, so still following the same scenario, things are not pretty ahead, yet the markets think we'll still have a blue sky ahead, and that makes a divergence between what the economical numbers are showing us and what the market itself is doing. And at that point, that's problematic to have such decorrelation between those two, because this is when we generally can create nasty bubbles in which the economical sector, the financial sector, is trading no matter what, no matter why. It's just we're going up for no reason, even if the economy is not following this, okay? And this is basically what we call bubble. Anyway, you aware of those? Bubbles can easily create at the end of economic cycles, so showing one in here wouldn't be really surprising. Would actually be normal. The only danger we have today is the fact that equities are already having quite some very dangerous risks already in place. We already have a credit bubble with that Q injection. We already have an economic war and currency war. And adding bubbles would be really piling all the most dangerous scenarios we could have. And at some point, things will get dirty. And if we piled up the risks, then the more risk we accumulated, the most brutal will be the reversal. So it's just in terms of economic stability, it wouldn't necessarily be a good choice to add a speculative bubble up to the risks we already have in place, and that will have to be corrected someday. We cannot have put it that much amount of billions into the market, adding liquidity without paying it at some point. Okay, there is going to be a reverse scenario in which the money is going to flow out of the market, and that will push price to more downside when it will occur. So consider this as a catalyst, okay? we will go into recession. That's a necessary thing. That's how economic works. And the fact that we had credit bubble will extend the bearish movements on that recession. So this is a risk. And adding another risk with the speculative bubble that is doing the exact same thing. Speculative bubble is pushing price to crazy high levels. And whenever we get down, we get to lower levels than necessary because we've been too high and we're going to get too low for the reason. Okay, consider it as an extended volatility of the cycle. We're going higher at the end of economic cycle and then we'll go lower than expected when we get to the correction. So if we extend because of credit bubble, if we extend correction because of speculative bubbles, and if we extend correction because of currency war, then what the hell? Is the market going to survive that? I'm not quite sure that we do. Actually, in the we've never seen, if we have to create a speculative bubble, then it means that we'll be into something we've never seen in the past. We will have nothing to compare to, which means we'll face something the market never, ever, ever had to face before. So it'll be a first case scenario, and who knows what the hell this will look like, if the market is going to survive this or not, how brutal could be the correction, what the impacts will be on the real economy. We don't know anything about that. Okay, but that's talking about economy. In here, so I'm just doing this in terms of introduction, and you really need to be aware that what you have in front of you, the numbers, the real economy, needs to be thought whenever you trade medium to long term, but that's it. In short-term trading, you don't give a shit about the economy. The market doesn't give a damn about the economy and can go crazy up for extended period of time without following economy, because the market isn't meant to follow economy. Okay, it's supposed to, but it doesn't really care about it at all, actually. If the market wants to go up, it will go up. With no reason, and the market can be more irrational than you will be liquid to follow that market. So be patient. We have suggestion that the market should stop moving to the upside, but if it keeps on doing it, you don't fight against it. That's really the key element of that introduction. Now moving on to the cryptocurrency market, that is what is getting you guys interesting, or interesting most of you guys. So what we are currently doing, if you remember the previous analysis, I told you that we were in the decision cluster right here. Okay, and we're still here actually. We try to exit, trigger the bullish pattern. No clear confirmation from the momentum, but as you can see, we had brutal reversal on the price. I said, okay, as this is not necessarily a double bullish signal, we can try making a short entry. I've been trying to short yesterday, been stopped out today, so I'm out. We're still back in here. We're not doing anything, okay? So we're back into the decision cluster. We try to fake it by the low, probably going to try it by the highs right now. So I suggest the most probable thing to see right now is trying to find a bullish extraction, and we'll see how this plays out. If this thing is managing to go higher and hold the price higher, then good for the bulls. But if somehow we make a fake bullish breakout and get back in once again, then basically the market is lost and doesn't know where to go. This is why you don't really trade in there, or you put very tiny leverage, just as I did yesterday. So it took a really tiny loss. To be honest, I've been losing 30 euros. So it really is nearly nothing I care about. So it was just a pure speculative trade on yesterday to forecast eventually following on the bearish trend. We don't. Means that we're still trading inside the range. We're right in the uninteresting price area, so don't trade in here. Or really go into betting 20 or 30 euros and don't put much more money than that. It really is a 50-50 scenario. Anyone who's trading right now is just trading stupid and making a 50% bet. So if you're right, you're going to get money. If you're wrong, you're going to lose money. It really is that simple. So make sure that you're losing less than what you get if you're picking the right side. Okay. And don't take too much risks, meaning the lower leverage you can get is what you should pick in here. Really being patient, that market doesn't necessarily know where to go. That's what it shows us. That's why it's not moving. So be patient. Don't rush things. At some point, we're going to take a decision and head toward either that cluster or this one. I really have no clues at that point. We're right in the middle of those two. And no signal. We have no signals to shift the balance. So in terms of cryptocurrency, cryptocurrencies is not that I don't want to trade, is that I don't have risk limitation enough to take a stand in here. So I simply don't. Okay, I'm no magician. Most of the time I don't know what the market has the most odds to do, and right now it's really 50-50. So I'd rather stay where we are, meaning I don't know what the market is doing right now, and I'm not trying to know. So I'm basically waiting. It either we go there, and those who want to buy can try eventual speculative bullish entries. Either we go there, and as a bear, this is where I'd like to take short entries, and that's it. Okay, so I'm basically wait for us to either go there or there, and finding eventual signals in there to trade. And if there's no signals, no trade. Other asset review right now. We're gonna switch to the U.S. equities. So what a day we had yesterday. The bulls managed to break it up. They took it over, made a 1% up day, opening at the low, closing at the high. No catalyst to push out the market, so it's just pure stop-loss chasing. Look at the volume. It's nearly nothing. We are far below the 20-day average, which means we're just in a no-selling market. It means there's no sellers in that market, and as always, when you're in an equity market, whenever you don't have sellers, the price always go up. The reason is pure and simple, because the market is meant to go up on the equities. When there's no sellers, the market is always buying to fill the gaps, and that pushes price higher. And the second reason is that we have monetary injections, which means that whenever we're neutral, then we always go to the bullish side. Okay, so when it's 50-50, it's always going to get to the bull side until the day that this beautiful mechanic is going to reverse, because once again, that's price manipulation. A free market, when you have no buyers, no seller, we wait to have an equilibrium, and it's either the buyers who are raising their interest into price, and then the price move upward, or the sellers are selling at lower prices and the price goes downward. But at some point, you have to wait to find the equilibrium. We don't know when we don't know what to do with the market. But in the equity market, as we have monetary injections, anytime we're not doing anything, we're obviously choosing the upside. So this is what we call price distortion. And as I said, any price distortion is going to have the reverse effect at some point. For now, we are still into monetary injection and market confidence that this will keep on doing that way. But believe me, at some time, this is going to reverse, and you don't want to be a buyer at that point, because any 50% choice will be to the bear side. As we went to the upside during the confidence market, we'll have the opposite side. When we get into bear market, any 50% choice will be chosen to the downside. Anyway, right now, as we haven't managed to find enough bears in here during that cycle and below that resistance, what we're simply doing is breaking to higher levels to find more aggressive bears. But the problem is that the more we do that, the more the bulls are getting confidence, the less confident the bears are, and the risk is for us to reach out the tipping point in where we're going to shift to a no return point in which we simply will exhaust the bears that they will no longer trade. And when we're in a market without bears, this is when we have the highest risks to create a bubble. So the risk right now is that we will have completely feared out the bears, that they will no longer trade, and if they're no longer trading bearish in a market that has no reason to go bullish, then we might be creating a bubble. And that's the risk we have right now. We're going to talk about the VIX manipulation right after. That's a pattern I've been talking to you about for quite some time, so that shouldn't be a surprise to you guys. So regarding the equity market, we had a 3 times manipulation. First manipulation occurred up there. We've got second one in here, and we got the third one happening right now. And as you can see, we are clearly creating a pattern in here. Okay, so we're going to switch to the 2-hour chart time frame. We're going to talk about that. So whenever we get there, just give me some time to delete those things, not necessary anymore. Okay. This was just to show you the multi-time frame sine wave. We're going to get to that later, okay? So if you want to show the equities right now, that's not nearly possible. We've got bullish breakout, but as you can see, we are probably creating what we call an ending diagonal. So this is nothing like a bullish structure, more likely a bearish one, but needs to be validated, and at some point it's still highly speculative, so don't put too much leverage into trading that scenario, and better wait for it to have validations before getting in, but that's not a bullish scenario we have right in front of us. Okay, so first VIX manipulation when the market tried to break up, but not managed to do it. The market didn't break up. It's just chased the stop losses of the bears, of two aggressive bears by that VIX manipulation. Then we went down 2 bearish waves, up 2 bullish waves, trying to break as well in here, failed it. So 2 bearish impulses and 2 bullish impulses, try to break once again, and we're probably going to fail this one. So yesterday I've been triggering stop losses. At least I took partial losses to reduce my risk. I was off the risk scenario, too risky in here, so I decided to take away the leverage in order to push the stop loss further away where the market shouldn't be able to take it. So now that I have bullish breakout, I need to adjust the risk. I was bearish, too aggressively bearish, so I took partial losses yesterday. It wasn't a good day. We're going to talk about the equity, the stocks, the independent stocks later on that show. Yesterday was a negative day to me. I'm not going to hide it. Once again, I'm not the kind of guy who hide from losses. I've been taking losses, but there are other scenarios that might be triggering some gains sooner or later, actually. So this is nothing. We're going to talk about those things later. So first manipulation, second manipulation, third manipulation, we can clearly see that this is creating some kind of trend line in here. That is creating what we call a wedge structure, and could be following on from an ending diagonal, which means we're not bullish in here. It's just 2 waves up, 2 waves down, 2 waves up, 2 waves down with a positive outcome that's induced by the manipulation we have on the VIX. But that thing doesn't suggest the market is bullish. More likely that this is the opposite, that we are trying to go bullish, and the moment we'll fail, we could have the opposite movement in the end. So I still forecast that price to be heavily bearish down the road, but for now I need to have confirmation of this, meaning that I need to reduce my leverage, putting my risk limit in here and waiting to have price confirmation. So I'm no longer speculating at that point in the US equities. I've been trying speculative entries in here, it's not working well. So I reduce the leverage, wait to have price confirmation. But if we fail in here, reverse the breakout and get to break down the trend line in here, I'll try consider making bearish entries. But this is only whenever we will break down that point that I will be ready to get into leverage trading. So for now, I stick to speculative leverage with an invalidation in here. Very tiny leverage, because my price entries are right there, meaning my average entry price is here. Invalidation is 3.26%, and I only accept a 2.5% loss in here. So you know how much leverage I have on those trades, and it's a leverage below 1. Okay, so I'm very tiny leverage right now because I think there is high level of risk trying to anticipate that market, meaning I reduced my leverage accordingly. Okay, so if the market is reaching that point, I will take a 2.5% loss. And basically, if we go there, I will no longer trade equities. I think at that point, we'll be creating a nasty bubble in which I don't want to be part of. Okay. But of course, if we fail in here and trigger my scenario, once again, validation of my scenario, I'll double down and multiply the leverage to get into chasing all the bull stop loss. All those who've been buying right now, if they're wrong-footed, they will have to exit brutally, and I'll be there to take their money. So for now, it's really being cautiously patient, not too much leverage, still speculative, accepting to be wrong. If the market is going there, I'll give away my stop loss, not hold on to my bearish trades. The bulls will win the game. I'll congratulate the bulls and wait for the next turn to come for me, meaning that I will wait for the bubble to take place, waiting for the bubble to reach out the no return points, and whenever we'll have that, I'll get back in to trade a market crash. But I won't be short in the meantime, because you don't want to be trading against a bubble, otherwise you're going to be into a nasty pain trade kind of scenario, and you don't want to be in this. So that's it about the equities. Of course, if you're a bull, what you'd like to see is that breakout validated, take out all the stop losses, mine included, and then you'll be good to go for a nasty bullish bubble trade. Second option, we get there, we chase and we trap the stop losses, which means we go there, bears are triggering bearish entry. you trap them in, and then you go fuck up all the stop losses. So this is one bullish trade I'll be eventually ready to take. If we go up there and fail to go down here to trigger the bull stop loss, we'll probably try to chase the bear stop loss afterwards. So this is one scenario I'm ready to eventually trade. Pulling back in here, finding some strength on the bull side in here, and if we get back to resistance afterwards, I'll be ready to join the bull side, but that's the only condition I want to do it. I don't think the market is bullish right now. All I think is that we need one more pullback before eventually getting higher with at least price construction. Okay, so for now we're chasing the bear stop loss. This is the only fuel the market is using. We have low volume, which means all we do in here is triggering stop losses of bears, and I don't want to be part of those. I gave away some stops yesterday because I was too much exposed to that market. Now that I'm back into normal trading and rational exposition on that market, I simply wait and get back to speculative trading. Okay, so I wait. This is the best tool for a speculator, having patience and waiting for your time to come. If I'm right, sooner or later my time will come. Volatility will pick up, equities will fall apart, and I'll be right and I'll take gains. But I would have been patient and rational into my trading approach. Okay, those who think the market will obviously go down are wrong, just as those who think the market will obviously go up are wrong as well. It's basically the hardest moment to trade and figure out what the equities will do. All the pros are trying to figure out what the hell is about to happen, and no one can give an answer. So let's face it, it really is a hard time to trade right now. Okay? And being some kind of lost and giving away some stop losses right now is absolutely normal. If you're making your gains right now, wow. It's either you are really a talented trader or you're really a noob trader, and whenever we'll take the decision, either up or downside, you're going to take losses once again, because this is not a market in which you're supposed to make gains. Most likely a market in which the best you can do is hold on to your past gains and not losing them, or you're just taking tiny losses by speculating, and at some point the market will take a decision and we'll get to making easy gains once again. So it's really being patient. The VIX has reached out to the no return point to me. We're in the area I've been highlighting previously when I thought we will trigger the bearish manipulation on the VIX back then in here. We failed doing it. But I think right now we reached out to this support anyway. We've got double bullish signal right here, which suggests at some point we should terminate that manipulation sooner or later. So it's basically being patient right now. But the VIX has reached out to really irrational risk levels, which means that at some point anything that stands out will basically fuck up those who've been selling volatility. So it's staying in as long as this can be manageable. And there are two options. At some point it's going to be too costly. It's going to cost too much to go to lower levels. So it's like the snake eating its own tail. At some point, it's not going to work out well, and we're going to have volatility back in that market just by reaching out the tipping point of the manipulation. And as you can see, those manipulations cannot last forever. Okay, so we've been into that manipulation for quite an extended period of time right now. Cannot last much longer than that. So at some point, we're going to retrieve volatility. And we're going to try to trade near 16, okay? Because that's how the volatility scenario is triggering. Anytime we get back to resistances, but fail to break them up, okay? So probably the next target into volatility levels is to get there, breaking the first resistance but not the second one. This is how the pattern is has been triggering in the past. So right now we should have pick up in volatility to get back to 17, but probably the volatility setters will again try to fuck up those who are trying to search volatility. So from what I can expect, we should have one more pullback in the equities with the volatility trying to reach out to 17, and this is where we'll have the decision cluster. So you guys have to put an alert in here. That level is really key to understand what's about to come. Probably going to fill that gap. Okay, so I strongly expect the market to go there in terms of volatility, and whenever we'll do that, probably going to fill the gap And the options are binary. Either the volatility sellers in here are losing it and we're crashing out the volatility, and then equities will fall apart, volatility seller will stop their shit, and we'll have a very brutal reversal on the market. That's the option I'd like to see, but once again, that's not necessarily what the market will do. Okay, we absolutely need to be patient in here. So option number one, volatility sellers are not doing that shit anymore. The market is collapsing and we're reaching out target number two to probably 31 on the VIX, and probably even nastier things if things are deteriorating. But I don't see the price moving much higher than that. So this is a target area. Let's consider 30. And at that point, equities will be bloody red if we go there, okay? So option number one, the one I'd like to see. Option number two, volatility sellers back in the game. We get in here, break that resistance, but not failing to get to the second one. Volatility sellers are selling 17 once again, and we get to lower levels. VIX is probably going to reach out to 10 or those stupid prices. And at that point, we'll slip one step ahead into creating a bubble. So these are the two options. Either volatility sellers keep on holding the bearish volatility and we'll go to create a bubble and get to historical highs on the SPX, at least getting to historical highs and eventually creating a bubble, option number one, or just getting historical high, finding volatility once again. And anytime the volatility is going to break resistances, we're going to get some nasty reversals, okay? Risk is down the road. You have to be aware of those. The market is no longer going to be calm and a tranquil movement. It's always going to be volatile right now, and at some time, volatility is going to pick up. It will just be a matter of time, okay? We know that we are at the end of the economic cycles, and creating a bubble is the only solution we can sell tranquility. Anyway, that's the scenario. If that scenario is the one the market is going to pick, then the only trade I'll be ready to take is by buying bonds. Okay, so I won't buy equities. I don't want to be part of a bubble creation for obvious reasons. Okay, I'm a human being and I have decency. Okay. And I don't want to be part of a bubble because I know what bubbles will do in their end. They'll fuck up the economy. They're creating thousands of jobless, and that's not something I want to be part of. Okay, it's just for ethical reasons. I not want to betray that bubble. Those who want to do it and have no mental condition doing it, then just do it. This is where you'll make gains by following the trend, following the bubble, and whatever. But I don't want to be part of this for the reasons, for ethical reason. I don't want to be part of what will create a market collapse afterwards and an economy collapse. Don't want to be part of this. Anyway, two options. Once again, it's just creating scenarios and then the market will decide. The market is the master in here. It's the one pulling the strings. You don't trade against the market. So option number one, equities are heading toward creating a bubble. In that case, we're going to have crazy rates in the bond market. So we'll have probably a bond market heading toward 3.7% on a 10-year yield, and that's a trade I'm ready to take, okay? You want to take crazy amount of risk and creating a bubble? Okay, I'm going to give you the money to do it, but I won't do it, okay? So I'm going to trade the bond market instead of the equity market if that's what the market is choosing. Option number two, taking profits on the bonds, retracing, equities falling apart, and then afterwards I'll be ready to make new bullish entries. From what I can see, this is what I forecast on the bond market. Creating ABC correction, getting to 4-point area, probably the lowest support, so eventually reaching out to there, creating ABC corrective structure or getting in here, and then afterwards the bonds will be bullish. But I think this is confirming that we have high probability to see the money moving out of risk into low risk area, probably probably causing a pullback on the yields to support areas near 2.6% on 10 years. And this is what I think the market is about to do. So being patient right now, but I see risk is down the road. VIX is down the bottom. Yields are pretty expensive, and they have room for a deeper pullback, which means money is probably going to flow out of equities back into the bond market. And gold is probably going to pick up as well. We're going to talk about this one pretty soon. So as you can see, gold is trying hard to break down, but it's not doing it. We're holding the trend line. We're creating higher lows. All we need right now is to create higher high. So I would like to see the gold breaking up to trigger triggers entries for me as a bull. I want to buy gold, okay? And once again, I'm not long-term bullish in gold, but only short to medium term bullish to get into that area in which I'll be selling gold afterwards. Whenever we get there, I'll be selling gold. Let's set things straight. I'm not bullish, long-term bullish on gold, but I think we need to go there, and we're going to do it brutally as the risk will pull out in the equity market. That's still my scenario. Now let's talk about something else. Euro dollar, okay? Euro is going upward, but be cautious in here. We've been reaching out to targets. So I've been taking my profits on the euro dollar. I'm no longer bullish in here. I think that breakout is a range breakout, which means we can go there, we can go slightly higher, but at some point we're going to find a market top and we're going to range that price area. I don't see the price going further away from here. So I've been taking my profits. And basically I'm no longer buying euro dollar. Okay, the goal was to take a counter trend trade. I've been doing it. We've been making 2 waves to the upside. I think that's it. It's too dangerous right now to remain bullish on that market. So you can forecast the market to go there, 100 to 127% extension. This is what the market generally does in that cases. ABC structure. Okay. So from what you can see, 2 waves upward, we're reaching 100%. Can go to 127, but as you can see, there's no demand in here. This is why I think we're going to stop in here. So I'd rather like to take my profits. Can go slightly higher, than I don't care. That was a counter trend trade. I'm not trying to buy low and sell at the highest points. All I was doing in here is buying interesting price, selling at better prices, taking gain, getting out. So that's a job done. Same thing on GBP USD. Been taking profit this morning. The market's falling apart, totally confirming what I thought. We're going to have a wave 2 consolidation. I'm waiting now to have price in that area. So I'll let that market consolidate for a bit, and then I'll get back into buying that market. But for now, I stick to remaining out of that market, waiting to have a consolidation, building in the prices. For now, I'm not doing anything in here. EURJPY is the next scenario I'll be triggering trades out of. I'm waiting to have a momentum confirmation in here, but as you can see, we're already in a bearish cycle. We have the bearish target in here. We've got a nice resistance. This is a price I'm ready to take. So right here, it to me is a bearish entry, limiting the market. So I'm entering right now, signals or not. Okay, this is a price I'm ready to take simply because the risk-reward ratio is really too interesting not to take it. So I'll be short entering in here. No matter what, signals or no signals, it's entering here with a stop loss in here above the 0.2. And what I forecast to have in here is what we've been talking about yesterday. So we'll see if you figure that out. If you got the point on yesterday's video in which we made Elliott wave forecasting tutorial. So what we have right here is probably going to be what we call divergent ending diagonal. Okay. So what we have right here is 5 bearish impulses with wave 1 and 4 overlapping, not overlapping. Wave 4 is entering into wave 1 territory. So this is what we have right now. And the diagonals out of origin to 2 point and 1 to 3 are divergent. They are not converging to the future. They are going opposite directions. Okay, so we're good to go. And we have a wave 3 that is bigger than wave 1 and is clearly identifiable by 2 sub-wave counts, A, B, C. We clearly have all the signal, all the checklist is validating that we can trade or anticipate a divergent ending diagonals. So whenever you have that, when you try to forecast the 5-point targets, you take extensions out of 2 to 4 to 3 back to 4 point whenever we'll have it. So for now, we're still waiting to find out 4 points. Of course, invalidation is breaking above 2 points. So this is where you take the invalidation on that trade. Cannot go higher than that. Otherwise, this is not an ending diagonal. But if we find a market top in here, we're going to fall apart in 2 or 3 waves, okay? Because once again, got 2 bearish impulses in here, so we can have 1, 2, 3, 4, 5 happening in here. Remember what we said yesterday, so it's either going to be an ABC or 1, 2, 3, 4, and 5 structure going to the downside, and the target will be at least 127% of the previous wave. So first target is in here, second optional target is in here. As you can see, it's pushing us to interesting prices. You see 161 is no support area, but we do have a support area in 127, so this is the one I forecast. This is where I'll take my profits on the Euro-Yen on that scenario. So this is where I get to take my profits. Okay, 127 extension out of the 4 point, meaning that for now we still need to validate that 4 point. All we know in terms of Elliott forecasting is that this is very likely going to happen in here, in that red area. So we're right into the activation zone. All I need right now is to have a momentum confirmation. So it's either momentum is triggering a pattern or we are breaking down supports. I already put in my alerts in here, and I'll sell Euro-Yen for sure. My stop loss will be there. It will be a speculative trade, but I will take that trade for sure. So that's the next trade I'll be triggering in the next following days. For now, I still wait to have a signal or a support breakout to get into that trade. AUDNZD, we also have to talk about this one. I've been raising the stop losses. You know I've been taking reinforcement entries right here, or right here to be precise. I warn you guys that I will take partial profits on that resistance. The price haven't reached out to there and failed before that, but we went above the previous B point, which means we can activate a potential structure which is WXY structure, and that's a dangerous extended correction in which we can go to lower lows, which means the buy entries I've been making out there, I've been putting a stop loss below that low. If we go there, I exit just to buy at better prices, which allows me to get more leverage if we go there than I had put it back in when I was buying down here. So it's either the market keep on pushing up and then I'm good, or the market it keeps on pushing down to get to lower retracements, and then I'll have better risk reward ratio in here to put more leverage. I'm still buying in AUD, just a buyer, obviously buyer of AUDNZD, no questions asked. It's just I'm trying to figure out what the market is doing right now and if I will be able to have better prices or not. So it's just a risk management kind of trade right now. So I'm raising the stop losses just to set things straight. And we keep on doing this. The thing, that's basically it. So we got to talk to Tesla, totally invalidated scenario. We broke up to the 4 points. So there's no longer a consolidating market in here. I don't really give a shit about what's happening with Tesla. All I know right now is that I don't know, and as long as this is that way, I'm not going to do anything with that market. We got validated bullish breakout. This is stupid. I don't really think this is a rational move, but I don't care. The market can be irrational. I have no signals to trade to the bullish side, so I'm out. Stop losses trigger right here. No losses. I've been shorting right now, so I've been taken out at entry points, so no loss in that scenario. But that's missing an expected nice gain. But anyway, that's happened. So we haven't reached out to validation of that trade. We reached out to invalidation. I'm out. Congratulations to the bulls. No matter how stupid that move is, you guys won. So congratulations. We'll see you next time. I'll still be short on Tesla. I'm just waiting for another technical framework to get back in. And for now, I just let the room for the bulls to go as high as they can. And we'll see how deep they can push that fucking price. Tesla is stupidly bought. There's no news in here. Still the same technical problems. Not enough lithium in Earth to build those batteries. So they are still selling dreams to whoever is ready to pay for this. So if you're ready to pay for that shit, then good for you. I'm not, so I'm simply waiting to have Tesla back into dangerous areas in which I'll get to back selling this to whoever is ready to buy it. But for now, there's no point selling, just being patient and let the bulls go crazy high. The higher it gets, the better the risk reward ratio will be to sell. So it's no problem. I'll let you guys push the price higher, but don't worry, I'll be there to sell you once again whenever that will be interesting to do it. It's not the case right now. So the only equities, the only stocks I still have in my portfolio right now is Apple. I'm waiting to see whether this thing is going there or slightly higher, reaching out to. So what's the structure in here? Once again, identify the structure. Divergent ending diagonals. Identify the structures. Wave 1 into waves. Retracement, wave 2, 2 waves, retracement, wave 5 in here. So it's 1, 2, 3, 4, 5. So we're in the last wave of an ending diagonal structure. All right, and we're generally target 127% of the previous impulse. We've been doing it, so we can reach out to the next level, which is 161%. Extension. Okay, sorry about that. No, I've been doing a mistake in here. This is what I like to have. Okay, so 161% extension is the next extension level we can reach out to on Apple. Okay, so this is what you guys can forecast in here. So we can eventually try to do it, knowing that we cannot reach out to the trend line, which means that if we want to go up, we'll have to go up slowly, meaning grinding our way up in here, pull backing, then pushing one more time in here, and whenever we get there, $200 for Apple, I'm short all the way down for a market crash, okay? Because ending diagonals are terminating a trend on the higher degree, which means we're in wave 5 in here of an overall wave 5. So we're going to terminate 2 wave counts, which means the retracement is going to be brutal. And to me, that's the retracement of the end of economic cycle, which means Apple is going to retrace in 2 waves. So it's ABC structure. Once again, that's not end of the world kind of scenario. It just means that the price will go to the downside in 2 waves. That's pure and simply this that I forecast to Apple. Not end of the world. The asset will remain bullish. It's just that the odds in terms of risk-reward ratio will switch to the downside, and we'll get much more reward by selling those things than buying them. We've got crazy gap in here. This will obviously going to be a target number 1. So I wait right now to see if the price is failing right here or going to 161 extension. So it's $200. So the guys will have $1,000 billion market cap. This is what all investors are crazy talking about right now. So bullish momentum, crazy bullish speculation. I see no reasons for the price not to go there. But when we get there, nasty things down the road, once again, the equity, the asset price is going to fall apart and probably going to lose 40% out of Apple. So if you're buying right now, be aware that the risk is losing 40% of your capital, and that's not something you want to risk. So it's either you take very short-term speculative trades to try to mess up with the end of that trend, or you're taking heavy amount of risk by staying and remaining inside that market. And that's a dangerous kind of scenario in here. And believe me, you don't want to be part of this. When risk reward is reversing, sorry, this is where I should have done my extensions. So this is where we are trading. Yes, and we're targeting 127 in here. All right. So anyway, that points out to the same area. So it's no matter what, this is where you want to take short entries on Apple, not touching the trend line. Okay. So this is the timing. So being patient, and probably in here, so let's say in a month or a couple months at best, we should have the market top in Apple. Long-term market top, meaning that the asset will be bearish for a couple years, okay? And once again, if you want to buy something that is going to be bearish for the next 2 years, then that's your problem. I'm not doing it. The other single asset I still have in my portfolio is Facebook. This one still needs to figure out if we are going to break to new highs or not. If we're doing, this one is going to be stopped out as well, which means I only have Apple in my portfolio. All the rest will have been taken down by the market. Boeing got invalidated yesterday as well. Stop loss was above that resistance. We broke it up, which means no bears. Even though we got exit, the breakout is validated. That market market is going to the upside. It will be the last wave. Once again, this is crazy bubble trading. We've got volatility picking up. We've got one more push to the upside. Next one is going to trigger a crash on the equity value, which means this one's going to lose at least 40 to 50% out of the equity price, no matter how high we can go. I don't know how high this thing can go. It's no rational trading anymore. So we have the final bullish impulse, volume is going to pick up, and then end of the trend, and then market crash, and probably, as I said, at least 40 to 50% loss in valuation. Once again, that won't be the end of the world. That will simply push us back there, which is price we were trading back at the end of 2017. And guess what? This was a bullish trend. Now this is just crazy speculative bubble, but this is not going to end pretty. Once again, such as trading, no magic. I know this thing is going to end, not to end well. It's going to end into bloodbath, but we still don't know when. It's just a matter of time. The market doesn't want to go bearish right now, but believe me, it will at some point. It's just being patiently waiting to have the confirmation of this. You can be sure I'll be inside that crashing market. It's just that I will wait to have new signals to do it. For now, bulls are too aggressive. I'll let them do their shit, but I'll be there to take the gains whenever the game will be over for the bulls. Now I'm going to take the questions you guys asked me. So you need to be aware this is how we do things in YouTube with the French guys, so I'm going to do the same with you. I'm going to take the questions you might be putting out there and answering those. So if you want to ask me a question regarding what I've been saying during that video, you can post a comment and I'll answer it in the next video. So I'm only taking reliable questions, okay? I'm not answering all the questions. All those that I have educational content are interesting. So, okay. Too long, then you just move on, okay? If this is too long for you, then just go away. I'm not here to make 10 minutes review, give you my trades, and give you easy trades to take. That's not how it works. I'm here to give you educational content. That's where the value is. If you just want the trades, then move on to someone else. Okay, thank yous. Thank you. Okay, yeah, you guys think the YouTube's better. I do think it that way too. Yeah, sideways action on the Bitcoin. Don't be too aggressive. That's still what I think is the most probable. Yeah, you got the point. Okay, it's longer, yes, but it's better quality, and that's all I care about. Okay, if you cannot spend 30 to 40 minutes a day to learn things into trading, then guess what? Move on to trading. You're not probably not gonna get return out of this. Yes. No, I don't think that's better. I'm going to give you a trick, okay? So whenever the asset I'm currently trading is always displayed in here by that blue highlighting. So if you want to know what assets I'm currently watching and studying, you just basically scroll the video in here using the scrolling button on YouTube, and you basically will know what asset I'm talking about. So if I'm talking about an asset you don't care about, you just move on to the next one. It's purely and simply that. So if you want to move on and simply watch out for specific assets, you just scroll the video and watch out for the watch list to know what I'm talking about currently. Let me know how I can add. Oh, you just get to the website and you subscribe to the free trial week. You got a week to test the indicators for absolutely free, and you're free to get in and out at any time. There's no subscription long-term plans. It's on a monthly basis, so you're never going to be engaged for a year or whatever. I'm not that kind of person who will try my best to get you in forever, okay? It's basically you get in and out as any time you want. You're free to go. That's how I think it is the best way to see that thing, to be durable, okay? You're never going to be locked in. Ever. If you're in, means that you find quality using the indicators. If you no longer find quality, you just get out. You're free to do it at any time. And that's it for the questions. So goodbye, guys, and see you tomorrow.